Thanks so much for tuning into Talking Point. I'm your host, Neeraj Shah. Our guest today is Vaibhav Sanghvi, CEO of ASK Hedge Solutions. Vaibhav, great having you. Thanks for taking the time out.
Thank you very much, Neeraj. It's always a pleasure to chat up with you.
Thank you so much. The case for a chat today, viewers, is of course heavy FI selling and the market's downtrend, whether it will continue further because it looks like the markets are in a bit of a downward spiral. FPI flows are muted in realty and some other pockets, but private flows are certainly on the rise. And monetary tightening and global stagnation has spurred foreign outflows. So what happens in a scenario like that? Can domestic flows come in and help the markets? Vaibhav, I would love to, in the latter half of the interview, try and understand how do experts like you hedge in times like these, which are so volatile. But let me start off with your basic bareback market view. What's the sense that you guys have at ASK about what could happen in the near term?
Yeah, I think Neeraj, before kind of understanding what can happen in the near term, and to be very honest, at this point in time, it's quite turbulent. We need to understand why have we reached at this stage, and what are the global factors which are kind of impacting the markets, not only India but across emerging markets as well as the developed markets as well. Now we in the last 18 to 24 months have seen interest rates kind of rise from 0% virtually to now at about 5%. That's a massive kind of increase of rates. At the same time, while the rates have kind of gone up, we have not seen any commensurate kind of effect in any of those kind of asset class, except for the debt side where we have seen yields kind of move up. Equities, in fact, have kind of strengthened. Now, it is very counterintuitive, and when people study about correlations in going into the history, you will generally find that whenever interest rates kind of rise sharply like these, or probably has to remain elevated, the natural consequence is basically that it kind of has an impact on the economy and subsequently the corporate earnings as well. Now, as I mentioned, till now, we've not seen any of those kind of effects, purely because now the governments are kind of leveraged pretty much on a higher level versus the corporates. But at some point in time, it has to kind of come and affect the equity markets and the various other asset classes, is what precisely we are kind of starting to see. The higher the yields which go from here, worse would be the kind of reaction. If yields stabilize and probably kind of move southwards, I think that would be better for equities.
Yeah, that's become difficult to time though, even for the central banks, I guess, Vaibhav.
I think it will take for a time, purely because the sole focus at this point in time from all the central bankers are inflation numbers. The moment they start witnessing inflation kind of cooling sustainably, and please mark my words, sustainably, it not only one print or two prints. I think they need to have that comfort in terms of the trajectory of inflation kind of moving southwards, is when we will see the monetary policy cooling off coming about. First, it may happen into the language, and then into probably the steps being taken in terms of the rates and the quantitative tightening programs as well.
Got it. Okay. Now, I mean, the common theory, Vaibhav, and there's a chart there is a part of a note which speaks about, which shows this beautiful chart on the index and shows how at different points of time there have been different crises and how the markets by and large have done well. Right? So it speaks about all the stuff that there thus far, and then also talks about the current one, which is the global stagflation concerns and the monetary tightening, and talks about what's the kind of fall that we've seen thus far and what could happen ahead. My question to you is, assuming that yields coming off is going to take time, assuming that the other factors are fluid and we don't quite know what happens, is this the extent of the downfall that you were expecting if you were? Or do you reckon that this has the potency to become steeper than what it is currently?
See, my worry, larger worry is basically trying to understand the unknown unknowns, right? In the sense that, whenever these kind of rates have kind of moved up, some other accident kind of happened, and whether it happens in any of those geographies, because it's a globalized world, I think it starts to impact, across the global markets. Now, where does this accident probably happen is anybody's guess. But my sense is basically the effect of these rise in rates has to happen, underlying, somewhere. Now, if you look at just as an example on the globe, on the housing markets, right? See the mortgage rates, see the subsequent kind of numbers. I think those are starting to kind of get reflected. Of course, the latest print was pretty, I would say, heartening or disheartening, you may say, probably because the numbers are pretty strong in terms of the housing sales. But it has to have some impact. When it has an impact, and when the subsequent chain reaction happens, that can have the potency of markets kind of, taking away some about 15 to 20%. But now it's too, I would say, it's preemptive to kind of guess that if the global bankers or if the global central banks are kind of able to have it on a very glided path down, downwards, towards a soft landing, and they are able to manage all those kind of transitory issues,
right?
It would be a wonderful thing. But it hardly happens.
It doesn't. FI flows, they seem to be, there's a bit of an outward spiral from a bunch of EMs, and likely because of the higher yields. Vaibhav, any thoughts here? I mean, is this, because seasonally, the next 2 months should ideally be good for flows and for markets, but we're not quite seeing proof of that. Yesterday was a big outflow day as well. What's your sense?
No, I think FPI flows, right? I think the direct correlation between the interest rates and to the strengthening of the dollar, or dollar index as well. Now, both of these accounts are kind of pitted against the emerging market flows. When we talk about emerging market flows in a broader context, India forms about 14 to 15% of that kind of basket. So if there is redemption in emerging market, on an overall basis, we will definitely face redemptions as well, or outflows as well by default. So it's not about India only and India doing fantastic. Of course, India is doing fantastic. The economy is very sound. We have seen all the macro numbers kind of right up there. It's just the sheer fact that the other emerging markets are not in a pretty good shape, and that is why we are seeing some amount of emerging market outflows, thereby witnessing outflows here as well. Now, just to point to one thing is, subsequent to when the rates started to increase by Fed, we have seen constant FPI kind of outflows to a point where our FPI ownership in 200 was about 21.5%. It's now come down to about 17.5%, or on a total basis. So this clearly reflects how much selling we've seen over a period of time, which has got compensated by the domestic flows. But that's a point we need to kind of worry about and take into cognizance.
Okay. So FPI flows may not be only about India. What is unique though, and maybe not unique, maybe it's happening in other places too, but from India's historical perspective, is the kind of mutual fund inflows. Now, do you reckon that will counterbalance to a large extent the FI outflows if they continue at the same pace out of India or EMs at large?
In fact, it has counterbalanced tremendously well in the last 1.5 years. Now, if we kind of pull back the same kind of outflow, which we have seen in 1.5 years, last 1.5 to 2 years, and if that situation would have occurred, 10 years ago, then my sense is basically the index would have given away by 35-40% by itself, right? That was a kind of outflow we had seen from an FPI perspective. It's just the sheer fact that the domestic inflow has been very resilient, strong, and thereby actually helped the overall indices, to not give away those kind of, gains, and to also decrease the overall volatility. But going forward, there are two aspects to be seen. One is basically on an overall valuation basis, right? While we are seeing the inflows, from the domestic investors, at some point in time, I think, to be very honest, the mid-cap and small-cap valuation kind of look pretty rich. And If you ask me whether could we make money on an immediate term, 1 year, 2 years, probably from a fundamental basis, I'm not very comfortable, in that kind of pocket. However, if you are looking for a 5-year, 10-year perspective, the whole theory kind of changes. So a valuation is not something which is in support at this point in time. Of course, the large cap is much better poised than the mid cap, small cap, but the larger flows we are seeing is going towards the broader market. If we start to witness the flows on the large cap side, then I think it may balance off the index kind of selling. But at this point in time, we may continue to see those kind of pressures from FPI, who are generally larger sellers on the large caps.
Got it. Vaibhav, how do you guys employ hedging strategies and try and give me some rope and not make it too complicated, because you guys must be doing some fairly esoteric stuff. I and my viewers would love to maybe understand a simplified version of the same, but would love to understand. And it will just probably help a lot of people who are listening to this to try and see if they can in their own way try and figure out if they can also deploy in some fashion some of the hedging strategies, because hedges would have worked beautifully at a time like this when the market has just come off really, really rapidly.
Now, first of all, Neeraj, a very simple concept to understand is basically that if we think about saying that if the markets are bad and I go and hedge it, to be very honest, it never happens. Because one, that you always have to keep on timing the market and keep on saying that this is the top of the market or this is the bottom of the market, which, to be very honest, you may get lucky once or twice and probably, but you cannot find that consistency at every given point in time. So that's one. Two, that for effective hedging, you always have to be in the market kind of hedging rather than, at a particular point in time, right? Why do I say this? Is basically, now, if I kind of, demarcate to events or probably risks to the market, I think there are known risks and there are unknown risks, right? Known risks, everybody knows that there is an event coming and I can probably hedge effectively. But there are unknown risks, something like a COVID or, some kind of event kind of comes about, or taper tantrum, or this last recent 5-7% fall, which out of nowhere it has kind of come in, right? To kind of capture that, you have to be in the market always, right? You cannot pick a point and say that I want to be hedged at this point in time and I'll kind of completely, get the advantage of my hedges in these kind of markets, right? However, when we talk about hedges, it comes with a cost, right? To kind of mitigate those kind of costs, there are various strategies. I don't want to get too complicated about it, but one has to understand that a hedging mindset cannot be occasional. It has to be on a consistent basis. How do you decrease the cost of hedges is something to be pondered over, on a longer debate.
Okay, fair call. Now, just a question, Vaibhav, because that is something that will be on top of everybody's mind. I don't know if it's possible to say that, but just still trying it out. Since March 2020, and except for that first fall, most large falls have got bottomed into very, very quickly, fairly convincingly. You could argue that October 2021 to March 2022 wasn't as quick per se, and the market stayed sideways quite a bit, but still we've had a bit of a pullback happen very, very swiftly. Is this time looking slightly different because of the geopolitics angle attached in a meaningful way?
No, of course, geopolitics is kind of having its own impact on the global economy. I would say the higher valuations also is kind of, making the problem a little, tricky, I would say. So it's not only about that. And on top of it, it's about the global monetary policies as well in terms of their interest rates. So there are a lot of variables kind of moving around at this point in time. But one point which I would make is basically, Neeraj, is you mentioned about COVID, right? And about the hedges. I would come to that point and a behavioral aspect as well to point out is if you go into the history of falls, right? Maybe you take 2008 or maybe you take a COVID period. You've always seen that during the fall and post the falls, while the markets are ready to be invested in, we have seen actual outflows happening during those period of times. So while there is a lot of education going into and saying that you should invest in the cheaper levels of the market, in fact, from a behavioral aspect, it actually happens on the opposite side. People actually redeem purely because the amount of negative news during that period of time is at so peak that people get too carried away and kind of go and exit their portfolios or trim their portfolios. So that is where you have your hedges kind of come in, give you that comfort on the portfolio, reduce your correlation, and give you ammunition to kind of go and invest during those kind of times.
Agreed. Okay. So Vaibhav, okay, let me wrap up with this. I would love to understand what is it that you're doing right now. Are you placing your bets on the downtrend continuing, but keeping hedges for a pullback that might come about if yields come off or whatever? Or are you now playing for a bounce back because we are at whatever 18,900, 800 odd, and the bounce back might be imminent, but should it correct further, you are keeping the hedges on the other side? What is it they're doing? And I'm using Nifty as a benchmark here. You might be trading on various indices, various pockets, various individual companies, but I'm just using Nifty as an example.
Sure. I think there can be a possible bounce back because we have fallen from about 20,000 to 18,800 odd levels. So I would not ignore the possibility of a bounce back. But to be very honest, being extra bullish or kind of go and aggressively go and buy, I would kind of refrain from doing that unless the macros kind of start falling into place, which I don't see happening kind of very soon. So in that respect, I would be a little cautious, and I do expect the volatility to be kind of elevated as well. Having said that, one last data point which I would mention is that typically ahead of elections, right, 6 months ahead of elections or general elections, you generally see a buoyant period. Okay, you just have to take care of it that you don't get carried away with that kind of rally which may probably happen because of the whole sentiment around, right? Have your kind of sights fixated on valuations, global macros, and the kind of risks which are kind of emanating. So there can be a temporary rally. Election periods are generally good. Sentiments and a festival period around are pretty buoyant. So you may see those kind of temporary pullbacks, but it doesn't merit at this point in time to be invested at that high valuations which we are seeing.
Vaibhav, I'm sure we are going to talk at least a couple of times before that for us to get that advice from you on that. So thank you so much for taking the time out, and to you and your team, a great build up to the festive season.
Thank you very much, Neeraj. Always a pleasure.
Thank you. Our pleasure is ours. Viewers, thanks for tuning in.